We covered the basic points of limited partnership deals in an earlier video linked below. Essentially, limited partnership entails investing in an existing commercial real estate project that is run by a general partner. The general partner takes on the financial risk for the entire project, while the limited partner only takes on risk in proportion to their equity invested. The flip side is, of course, that the limited partner also reaps the rewards in proportion to their investment. LP deals are a good way to diversify your portfolio across asset types, as well as limit your risk. Instead of putting one large down payment on a single commercial building, you can instead spread that amount across multiple deals. But what about exiting a limited partnership? How does that work? That usually comes down to two questions. The first is, are you investing in a project-specific deal, like a predefined deal on one property that you know in advance, or are you investing in a fund that invests in multiple deals? A fund, which is sometimes called a blind fund, will usually have a predefined scope of what types of projects it would invest in. That might mean the fund invests in Bozeman-based apartment projects that anticipates a target internal rate of return of 16% and cash-on-cash average yield of 6%, for instance. Project-specific deals will generally keep LPs locked in while the business plan runs its course. If you put money in at the outset and want to get out prior to the planned exit in the business plan, it's often difficult to do so. In that way, they are somewhat illiquid. When the project sells, there is sometimes, but not always, an option to stay with the entity and do a 1031 exchange into the next project. However, that requires lining up a bunch of moving parts. Most of the time, a deal gets to its planned end state, the property is sold, and the distributions are made in accordance with the operating agreement. If the individual investors are happy with the performance of the investment and want to stick with the sponsor on the next project, they can often do so by starting the process over and rolling proceeds from one successful deal forward into another one. With a fund, there are usually more jumping off points than with a project-specific deal, meaning that when a liquidity event occurs for the fund, it provides an opportunity for investors to get in and to get out. Those liquidity events could be a sale or a refinance of an individual asset within the fund's portfolio that opens up cash to allow investors to cash out if desired. There are usually restrictions on how this can happen since not everyone can cash out all at once. So we've covered what a limited partnership looks like and how you can get in and get out of one. If you are ready to jump into a limited partnership, how can you determine a good opportunity? Catch up on the next How Does That Work for the answers. Thanks for watching.